The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we work through midweek trade, we saw a little bit of downward pressure in the grains, kind of a mixed bag of corn and wheat, pressure in soy with a lot in front of these markets here, a lot of technical trading, it felt like, on the day Wednesday. But of course, we got those big reports coming up on Friday from USDA. So we're going to break it all down. Joining us for a conversation, Mike Zuzolo with Global Commodity Analytics. Mike, always good to talk with you, my friend. And I know we were chatting before we went on the air here. You were able to dig out from some of that heavy snow that hit you there in Kansas. So glad we could chat today.
Yeah, me too. It's a great time to talk to Jesse ahead of the WASDE report Friday and the CPI data coming out on Thursday. But yeah, this weather, putting it at kind of a fine point on it, I don't think a lot of weather people were thinking that January was going to be cold. In fact, they were saying it was going to be in the plain states hot and dry. And that could really create some havoc in the hard red wheat price action, as well as the cattle and hog price action.
Definitely. I couldn't agree more. And I know we're going to talk livestock here a little bit later on. I want to start with the overall grain picture. And I guess before we really dive into the report, let's look at what we're seeing on Wednesday. You brought up the CPI data that's going to be coming out Thursday. And largely, like I said, the grains, it was kind of a mixed bag with more pressure in soybeans. And to me, it felt largely technical kind of trading on Wednesday and consolidation type trading. Is that kind of what you thought, Mike?
Yeah, in the soy complex especially, I think you nailed it there. The meal market had been dancing on a 3-year trend line support right around that 364.50 area. If we lose that 3-year support trend line, it really opens up the downside, kind of like what we saw in the beans a week or two ago. And then there's another kind of a slide off in the monthly bean chart as well that kind of corresponds pretty well with the meal not hitting another trend line for another $30 to $40 lower. So this is a really key point, is the January contracts for meal and oil and beans are going off on Friday, the same day as the report. And I'd really like to see that 3-year support trend line hold in there as January expires, because as we remember, the meal was still staying inverted in terms of the Jan holding a premium over the March as we went into the delivery. And we really need to keep that intact in order to offset some of this better weather and this more bearish mindset that the soybeans are needing to go down to play catch up with the corn and wheat and pull weather premium out that corn and wheat had seen weather premium pulled out several weeks, if not a couple months back.
Well, in terms of this soybean market too, we talk a lot about South American weather. That's been the sexy headline here, and rightfully so. It is a very important issue, but China really hasn't been in this soybean market in quite some time. We haven't seen much in the way of any flash sales, really, I think, in a couple of weeks now. And I really enjoy our midweek conversations because you look at a lot of different analysis. And looking at a chart here on the video feed, China inflationary data. Talk to me a little bit about this and how it can maybe parlay itself into what we're seeing in this soy complex, especially right now.
There's a lot to unpack here. And so, we can talk on a one-to-one level after the show. If you want to, take the globalcomresearch.com website and take a hit there and ask for a subscription trial period, because what this chart really shows, Jesse, is I think the fear in the market that's manifesting itself in the trade for the grains in the commodity sector as a whole, led by the wheat, led by the crude oil. And again, those are the two leaders for me in early 2024. If we're going to make a low in the commodity sector, I think it's going to show up in wheat and crude oil first. But what we see in the green rectangle is the China PPI at purple and the food CPI in the blue. And they're both running deep in negative territory right now in 2024. In fact, the food CPI has been running in negative territory for many months at this stage, almost 5 months at this point. And the last time we've been in this type of scenario where both were deep in the red and deep in negative territory was that 2015 through 2018 time period. And I think this chart shows what the trade is fearful of seeing in terms of commodity prices, and prices continuing to go lower and lower and lower and not find any support. And I think this is where Friday's WASDE report, to me, is a key element to setting this market back in terms of a reset and bringing back, instead of a negative demand mindset, such as in crude oil, or as you say in soybeans with no fresh sales with China, we want to see the supply side again and see if CONAB's numbers, which came out today, which barely made any difference in the trading price action, are going to be taken up by USDA, and see what that does to the world ending stocks, because CONAB's corn number is now below 118 compared to USDA's 129. Their new CONAB, bean number is 155.3 versus USDA's 161 million metric ton number back in December. I just don't think we're pricing this damage already been done on the supply side and in the weather in South America in yet. And if I'm wrong about that, and we get what USDA, they confirm CONAB's numbers and the market doesn't react accordingly, then I've got to start worrying about this chart a lot more and that price action that goes back to that 2015 to 2018 time period.
Well, and it's I'm glad you brought up CONAB, because I was going to talk about that too, and I'm glad we're tying that in with this chart here, Mike, because I'm with you. I was quite surprised there wasn't more of a market reaction to those CONAB numbers. I wonder if too many people are just putting a lot of emphasis on whatever USDA is going to say on Friday, and really just kind of throwing the CONAB numbers out the window, because these USDA reports coming up on Friday are always very important as kind of a stage set for the year, Mike.
I think that's a real possibility, if not a probability, because if I remember correctly, that's what we did last month. CONAB came in with the lower number. USDA met them a little bit on beans by taking the bean number down 2 million tons, but they didn't change the corn at all. CONAB was still around 118, 119 at that time. And Jesse, I think you hit upon the sentiment and momentum indicators that I look at so much when it comes to the funds and the investment flows, because they help, I think, suggest in the trade whether we're losing real demand in 2024 or we just perceive we're losing demand right now. And I think a lot of this can be tracked back to China once again, in terms of them talking about, they being President Xi, talking about reunifying China. And that sent alarm bells through the commodity trade this past week or two when it came to what was going on with Taiwan with their election. Guess what? Right around the corner this weekend, and probably won't know much until early next week. So I really see this mid-January time period as a major time period for joining the supply demand back together and hopefully, as I said, bringing a reset into these markets.
We got the latest EIA numbers out on a Wednesday as well. Look at this chart. Talk to me about what you're seeing here, and just with the overall numbers we got out from the energy side here, ethanol numbers, et cetera, here this week.
Yeah, this chart shows you the distillates and the stocks build very far right. Look at the sharp move up in distillates and unleaded gasoline stocks. We're back up to 132 million barrels of distillates. That puts you up to the highest level since September 2021. Now, two things about this chart, Jess. If you look at the green areas, right when the green areas start, that's going to be your different quarters. And if you look at the beginning of a year, typically in Q1 of about every year, we see big stocks builds in the unleaded and even in the distillates sometimes. And even though you're using a lot of heating oil in the wintertime, you still tend to see a big stocks build after the first of the year in each year typically. So this is not uncommon, but I think what this type of chart and this reaction by the trade today in the crude oil market, again, one of our major leaders, and why we're looking at this chart today, I think one of the things that was a reaction and a consequence of this chart was the trade saying, look, see, we're right. There's no demand out there. We're losing demand. And then you saw the ethanol numbers. They too showed a little bit better production number, but they also saw a very big stocks build. So we got to really wonder, are we in a recession right now? And I think that's part of the element of this overall demand picture.
Ethanol margins, are you worried about where ethanol margins are at right now in terms of this corn market, Mike?
Yeah, it's interesting because I looked at those right before going on the air. And if you look at Northeast Iowa, North Central Iowa, you're talking probably 13 to 30 cents in the red right now, from what I can tell. That, I think, is a signature of your basis improving in a lot of these areas where there's ethanol plants. It's not nearly where it was, but it's been improving while this futures market's going down. So, yes, that is kind of in a yellow alert area for me right now. I'd want to see those margins go back positive. And honestly, I'd like to see the unleaded and distillate stocks go down as we get into Q2, just like they typically do seasonally.
We are joined today by Mike Zuzolo from Global Commodity Analytics as we talk about the Wednesday market action and preview Friday's reports. And let's talk a little bit more about what we're going to have in store from USDA coming up on Friday. It's really a data dump, Mike, for lack of a better term. There is a lot that gets thrown at this market. I want to talk about world corn ending stocks first. You gave us this chart as well on our video feed. Let's start here and just talk about what you're seeing and what you're expecting on the corn side heading into Friday's reports.
Yeah, this is one of the major points of this reset that I'm talking about, because I think we've got strong enough corn demand. We shouldn't lose any exports. I think we could still see an acreage or yield shift to cut the production down a little bit. And I still think that we have a decent chance of getting closer to my ending stocks number of about 1.97, 1.95 billion for 23-24. On top of that, we have this massive disparate distinction between where CONAB, the official Brazilian agency, is versus USDA on corn production. And we're talking about a 12 to 15 million ton difference in terms of private estimates versus USDA. And that would open up the door for as much as 30, 35 million metric tons of lower exports for corn in the 24-25 marketing year versus what USDA is probably going to give us in the early part of the year. So it really is about the corn ending stocks number for me on the global basis. USDA came in at 315 last month. The average trade guess on one of the big news wires is 313.8. The range is 309.5 to 318. I'm at 306.3 with the idea that we are going to see some changes in both Brazil and the United States and not lose demand. Now, if I get that kind of a number or close to it, say we go down to the low end of the range of 309.5 on the newswire estimates, I'd call that a victory, because then all of a sudden our stocks to use ratios, Jesse, get really tight, like 4-year tight, and even banging on 9-10-year tight stocks to use ratios.
Another chart we'll look at as well, the global coarse grain stocks. Talk about this chart here and kind of what you're seeing, and tie this in with the world corn chart we just looked at.
Yeah, coarse grains is typically 90%, corn is typically about 90% of the coarse grains. And I like the coarse grains because it encompasses all that you can think of in terms of competitors with corn. And what we're looking at here is a coarse grain stocks to use ratios chart going all the way back to 1984. And that's your bars. Your red line, though, is the U.S. average cash price. So take a look at the area where the red lines go sharply higher. There's really only two that you can see since 2005, 2006. One was the obvious drought year of 2012, and then the other one was just recently here with the Ukraine-Russia war. But notice where the stocks to use ratios need to be in order to get this type of a market reaction in the stocks, in the average price for corn. I am putting a 24-25 coarse grain stocks to use ratio at a little under 23%, and that takes you down to a 4-year low. And if we could lose another 0.5%, all of a sudden we're down the lowest level since 2014. I would say that most analysts right now, that at least that I have heard through clients, are not really looking at this tight of a situation. But this is where the January crop report, Friday's crop report, could set us off into rethinking whether we have ample supplies globally of corn or not. Because these numbers, I'm not overdoing it on the demand. I'm not overdoing it on yields. I'm really trying to live with 2, 3, 5-year averages, and I still stay that tight, especially if I'm right about the Brazil number being 118.
Well, at the end of the day, Mike, going into any report, and especially this one, we know there could be surprises. We know it could be volatile. And we could do everything we can to forecast and guess what USDA is going to give us. But until we see those numbers come out on Friday, we don't exactly know. But again, we can look at a lot of great analysis like you do. So, in your eyes, with your analysis, thinking risk management here ahead of Friday's reports, what do folks need to remember with grains in terms of risk management?
Yeah, for me, I've made the case that corn should be the bright spot of this report. You can get a decent March call option in the corn for well under 10 cents a bushel, including costs. And I think that's something to look at for those off the combine bushels or last 30-day bushels that you've had to sell in this hole as the market's going down. I think the big thing that you brought to my mind when you framed what you just said, Jesse, was 2023. A year ago today, we were thinking about 2012 drought, and we were thinking about unbelievably high cattle prices. We got high cattle prices, but nothing close to what many thought we would get, and we didn't get that 2012 drought. We're a year on now, and we're actually on the exact opposite mindset. We're worried like crazy about the cattle prices. We're worried like crazy about corn prices going lower because of China especially. And it's just amazing to me how we've gone from one extreme to the other. And that's why I try and do what I do with the value level analysis, and what you and I just went through briefly is try and put both sides of the equation together, the funds and the fundamentals. This may be one of the best buying opportunities for the commodities as an investment class. We just need a couple things to go right with us. The first one being that USDA report.
Well, we'll see what USDA throws our way on Friday, and it's no doubt going to be a fun day in the markets. Mike, let's go over to livestock, and you brought up the winter weather. Your thoughts? I'm surprised we maybe haven't seen the winter weather completely impact either the cattle or the hog markets here this week. At least that's what it feels like to me. I don't think we've seen a whole lot of weather premium thrown in here, even though that snow really blasting some key parts of feedlot country. So talk about that a little bit. Do you think this has already been put into the market or not here right now, Mike?
No, I agree with you. I think part of it has in the hog market, and I think the cattle market could have gone lower had it not been for the weather. But I think two things the market's really watching for to get a better indication of what direction to take this market is Friday's report, because we get updated livestock numbers there as well, very important livestock numbers. But even more importantly, we don't really know what this winter weather has done to the consumption side in terms of grocery store and restaurants. We don't know, because these weather models keep shifting, where the snow's going to be and where the cold's going to, whether it's going to lay in here for the next 30 to 45 days or not. These uncertainties, I think, are keeping some potential longs off the market and out of the marketplace, Jesse. If I had to guess, we have more longs sitting on the sidelines than we do more shorts at this point. And I think that's especially important given that we do get this CPI inflation data along with the weekly export sales for the livestock market on Thursday. So these two major things surrounded by some other minor things make me think cattle markets probably need to go higher. I still feel like by the end of this month, we should be in the mid 170s as far as a fair price, maybe even higher than that, depending on how cold we get, because I do have ranchers really starting to get nervous with these new weather patterns that are coming out.
Yeah, and that's something to watch closely is how this all impacts in this cold weather that's on tap, how this impacts our cattle ranchers and the health of our herds out there. And I was just looking at some of the market closes too. Hogs, I thought maybe we were running out of some futures steam, but then we eked out some more green on the screen there. So what is that, 5 sessions in a row, I believe, Mike? Hey, don't look now, but hogs trying to stage a rally here a little bit.
Yeah, it feels a lot better to be at 71, 72 than 50, 52. So that's a really nice thing. The other thing I'd say about the cattle, kind of similar to what I was talking about on the corn, Jess, is feeder cattle have a 52-week moving average support level right around 221.80 area. I'd be really disappointed if we take that out on a weekly basis, given this weather and given what I think packers are pretty short bought at this point because they've been running in the red so deeply. They're probably not really wanting to kill too much and put it in the storage.
Mike, always enjoy the conversation. Anything final you want to share or reiterate for folks today?
No, I just want to reiterate the idea that a lot of data coming out here in the next 30 days. Sign up for a newsletter for 3 months. It's only $100 at globalcomresearch.com. You'll also get all my text blasts as well for 3 months. It's a really good value, and I think you'll enjoy our research.
GlobalCom with 2 M's, research.com. That's where you can find Mike Zuzolo with Global Commodity Analytics. Mike, always great to chat. Have an awesome rest of your week, and we will talk to you next week.
Thanks, Jesse. You too.
That's going to do it for Market Talk today. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.